criticized the preoccupation of economic theory with the equilibrium position. What better example could I find than the stock market? Existing theories about the behavior of stock prices are remarkably inadequate. They are of so little value to the practitioner that I am not even fully familiar with them. The fact that I could get by without them speaks for itself. Generally, theories fall into two categories: fundamentalist and technical. More recently, the random walk theory has come into vogue. This theory holds that the market fully discounts all future developments so that the individual participant's chances of over- or underperforming the market as a whole are even. This line of argument has served as theoretical justification for the increasing number of institutions that invest their money in index funds. The theory is manifestly false. I have disproved it by consistently outperforming the averages over a period of 12 years. Institutions may be well advised to invest in index funds rather than making specific investment decisions, but the reason is to be found in their substandard performance, not in the impossibility of outperforming the averages. Technical analysis studies market patterns and the demand and supply of stocks. It has undoubted merit in predicting probabilities, but not the actual course of events. For the purposes of this discussion, it is of no particular interest because it has little theoretical foundation, other than the assertions that stock prices are determined by their supply and demand, and that past experience is relevant in predicting the future. Fundamental analysis is more interesting because it is an outgrowth of equilibrium theory. Stocks are supposed to have a true or fundamental value as distinct from their current market price. The fundamental value of a stock may be defined either in relation to the earning power of the underlying assets or in relation to the fundamental value of other stocks. In either case, the market price of a stock is supposed to tend toward its fundamental value over a period of time, so that the analysis of fundamental values provides a useful guide to investment decisions. The important point about this approach is that the connection between stock prices and the companies whose stocks are traded is assumed to be in one direction. The fortunes of the companies determine, however belatedly, the relative values of the various stocks traded in the stock market. The possibility that stock market developments may affect the fortunes of the companies is left out of account. There is a clear parallel with the theory of price, where the indifference curve determines the relative amounts consumed, and the possibility that the market may influence the indifference curve is disregarded. The parallel is not accidental. The fundamentalist approach is based on the theory of price. But the omission is more glaring in the stock market than in other markets. Stock market valuations have a direct way of influencing underlying values, through the issue and repurchase of shares and options, and through corporate transactions of all kinds, mergers, acquisitions, going public, going private, and so on. There are also more subtle ways in which stock prices may influence the standing of a company: credit rating, consumer acceptance, management credibility, etc. The influence of these factors on stock prices is, of course, fully recognized. It is the influence of stock prices on these factors that is so strangely ignored by the fundamentalist approach. If there are any glaring discrepancies between prevailing stock prices and fundamental values, they are attributed to future developments in the companies concerned that are not yet known but are correctly anticipated by the stock market. Movements in stock prices are believed to precede the developments that subsequently justify them. How future developments ought to be discounted is the subject of an ongoing debate, but it is presumed that the market is doing the job correctly, even if the correct method cannot be theoretically established. This point of view follows naturally from the theory of perfect competition. It is summed up in the assertion that the market is always right. The assertion is generally accepted, even by people who do not put much faith in fundamental analysis. I take a totally opposite point of view. I do not accept the proposition that stock prices are a passive reflection of underlying values, nor do I accept the proposition that the reflection tends to correspond to the underlying value. I contend that market valuations are always distorted. Moreover, and this is the crucial departure from equilibrium theory, the distortions can affect the underlying values. Stock prices are not merely passive reflections. They are active ingredients in a process in which both stock prices and the fortunes of the companies whose stocks are traded are determined. In other words, I regard changes in stock prices as part of a historical process, and I focus on the discrepancy between the participants' expectations and the actual course of events as a causal factor in that process. To explain the process, I take the discrepancy as my starting point. I do not rule out the possibility that events may actually correspond to people's expectations, but I treat it as a limiting case. Translating this assertion into market terms, I claim that market participants are always biased in one way or another. I do not deny that markets have a predictive or anticipating power that seems uncanny at times, but I argue that it can be explained by the influence that the participant's bias has on the course of events. For instance, the stock market is generally believed to anticipate recessions. It would be more correct to say that it can help to precipitate them. Thus, I replace the assertion that markets are always right with two others. 1. Markets are always biased in one direction or another. 2. Markets can influence the events that they anticipate. The combination of these two assertions explains why markets may so often appear to anticipate events correctly. Using the participant's bias as our starting point, we can try to build a model of the interaction between the participants' views and the situation in which they participate. What makes the analysis so difficult is that the participants' views are part of the situation to which they relate. To make any sense of such a complex situation, we need to simplify it. I introduced a simplifying concept when I spoke of the participant's bias. Now I want to take the argument a step further and introduce the concept of a prevailing bias. Markets have many participants whose views are bound to differ. I shall assume that many of the individual biases cancel each other out, leaving what I call the prevailing bias. This assumption is not appropriate to all historical processes, but it does apply to the stock market and to other markets as well. What makes the procedure of aggregating individual perceptions legitimate is that they can be related to a common denominator, namely, stock prices. In other historical processes, the participants' views are too diffuse to be aggregated, and the concept of a prevailing bias becomes little more than a metaphor. In these cases, a different model may be needed, but in the stock market, the participant's bias finds expression in purchases and sales. Other things being equal, A positive bias leads to rising stock prices and a negative one to falling prices. Thus, the prevailing bias is an observable phenomenon. Other things are, of course, never equal. We need to know a little more about those other things in order to build our model. At this point, I shall introduce a second simplifying concept. I shall postulate an underlying trend that influences the movement of stock prices whether it is recognized by investors or not. The influence on stock prices will, of course, vary, depending on the market participants' views. The trend in stock prices can then be envisioned as a composite of the underlying trend and the prevailing bias. How do these two factors interact? It will be recalled that there are two connections at play, the participating and the cognitive functions. The underlying trend influences the participants' perceptions through the cognitive function. The resulting change in perceptions affects the situation through the participating function. In the case of the stock market, the primary impact is on stock prices. The change in stock prices may, in turn, affect both the participants' bias and the underlying trend. We have here a reflexive relationship in which stock prices are determined by two factors, underlying trend and prevailing bias, both of which are in turn influenced by stock prices. The interplay between stock prices and the other two factors has no constant. What is supposed to be the independent variable in one function is the dependent variable in the other. Without a constant, there is no tendency toward equilibrium. The sequence of events is best interpreted as a process of historical change in which none of the variables, stock prices, underlying trend, and prevailing bias, remains as it was before. In the typical sequence, the three variables reinforce each other, first in one direction and then in the other, in a pattern that is known in its simplest form as boom and bust. First, we must start with some definitions. When stock prices reinforce the underlying trend, we shall call the trend self-reinforcing. When they work in the opposite direction, self-correcting. The same terminology holds for the prevailing bias. It can be self-reinforcing or self-correcting. It is important to realize what these terms mean. When a trend is reinforced, it accelerates. When the bias is reinforced, the divergence between expectations and the actual course of future stock prices gets wider, and, conversely, when it is self-correcting, the divergence gets narrower. As far as stock prices are concerned, we shall describe them simply as rising and falling. When the prevailing bias helps to raise prices, we shall call it positive. When it works in the opposite direction, negative. Thus, rising prices are reinforced by a positive bias and falling prices by a negative one. In a boom-bust sequence, we would expect to find at least one stretch where rising prices are reinforced by a positive bias and another where falling prices are reinforced by a negative bias. There must also be a point where the underlying trend and the prevailing bias combine to reverse the trend in stock prices. Let us now try to build a rudimentary model of boom and bust. We start with an underlying trend that is not yet recognized, although a prevailing bias that is not yet reflected in stock prices is also conceivable. Thus, the prevailing bias is negative to start with. When the market participants recognize the trend, this change in perceptions will affect stock prices. The change in stock prices may or may not affect the underlying trend. In the latter case, there is little more to discuss. In the former case, we have the beginning of a self-reinforcing process. The enhanced trend will affect the prevailing bias in one of two ways. It will lead to the expectation of further acceleration or to the expectation of a correction. In the latter case, the underlying trend may or may not survive the correction in stock prices. In the former case, a positive bias develops, causing a further rise in stock prices and a further acceleration in the underlying trend. As long as the bias is self-reinforcing, expectations rise even faster than stock prices. The underlying trend becomes increasingly influenced by stock prices, and the rise in stock prices becomes increasingly dependent on the prevailing bias, so that both the underlying trend and the prevailing bias become increasingly vulnerable. Eventually, the trend in prices cannot sustain prevailing expectations, and a correction sets in. Disappointed expectations have a negative effect on stock prices, and faltering stock prices weaken the underlying trend. If the underlying trend has become overly dependent on stock prices, the correction may turn into a total reversal. In that case, stock prices fall, the underlying trend is reversed, and expectations fall even further. In this way, a self-reinforcing process gets started in the opposite direction. Eventually, the downturn also reaches a climax and reverses itself. Typically, a self-reinforcing process undergoes orderly corrections in the early stages, and if it survives them, the bias tends to be reinforced and is less easily shaken. When the process is advanced, corrections become scarcer and the danger of a climactic reversal greater. A few words about the theoretical construction of the model may be in order. We are interested in the interplay between the participant's bias and the actual course of events. The great merit of this construction is that it uses variables that can be quantified. Stock prices serve as a convenient proxy for the situation to which the participant's bias relates. In other historical processes, the situation that is interconnected with the participant's perception by the cognitive and participating functions is more difficult to identify and impossible to quantify. It is the availability of a convenient proxy that renders the stock market such a useful laboratory for studying reflexivity. Unfortunately, the model offers only a partial explanation of how stock prices are determined. The concept of an underlying trend has been introduced as a placeholder term to denote changes in the fundamentals. What the fundamentals are has not been defined. Even the question of how the fundamentals are to be measured has not been answered. Earnings, dividends, asset value, free cash flow, all these yardsticks are relevant, as well as many others, but the relative weight given to each depends on the investor's judgments and is therefore subject to their bias. We may use earnings per share for purposes of illustration, but that merely begs the question. It is a question security analysts have been struggling with for a long time. We do not need to answer it here in order to develop a theory of reflexivity. Without knowing anything about the fundamentals, we can make some worthwhile generalizations. The first generalization is that stock prices must have some effect on the fundamentals, whatever they are, in order to create a boom-bust pattern. Sometimes the connection is direct, as in the examples I shall use in this chapter, but generally it is indirect. Often it makes its effect felt through a political process, such as changes in taxation or regulation, or attitudes to saving and investing. It is possible to have a reflexive connection between stock prices and the prevailing bias, even if the fundamentals remain unaffected. But the connection becomes interesting only if the fundamentals are also involved. Without a change in fundamentals, the prevailing bias is likely to be corrected in short order, as we can observe in the daily fluctuations of stock prices. It would be quite in order to ignore the bias as mere noise. That is what the theory of perfect competition and the fundamentalist approach to security analysis have done. By contrast, when the fundamentals are affected, the bias cannot be left out of account without serious distortion, because the bias gives rise to a self-reinforcing, self-defeating process that leaves neither stock prices, nor the fundamentals, nor the participants' views the same as they were before. The second generalization is that there is bound to be a flaw in the participants' perception of the fundamentals. The flaw may not be apparent in the early stages, but it is likely to manifest itself later on. When it does, it sets the stage for a reversal in the prevailing bias. If the change in bias reverses the underlying trend, a self-reinforcing process is set in motion in the opposite direction. What the flaw is, and how and when it is likely to manifest itself, are the keys to understanding boom-bust sequences. The model I presented above is built on these two generalizations. It hardly needs emphasizing how crude the model is. Nevertheless, it is valuable in identifying the crucial features of a typical boom-bust sequence. These are the unrecognized trend, the beginning of a self-reinforcing process, the successful test, the growing conviction, resulting in a widening divergence between reality and expectations, the flaw in perceptions, the climax, a self-reinforcing process in the opposite direction. Just by identifying these features, we can gain some insight into the behavior of stock prices. We cannot expect much more from our rudimentary model. In any case, a reflexive model cannot take the place of fundamental analysis. All it can do is to provide an ingredient that is missing from it. In principle, the two approaches could be reconciled. Fundamental analysis seeks to establish how underlying values are reflected in stock prices, whereas the theory of reflexivity shows how stock prices can influence underlying values. One provides a static picture, the other a dynamic one. A theory that offers a partial explanation of stock price movements can be very useful to the investor, especially if it illuminates a relationship that other investors fail to grasp. Investors operate with limited funds and limited intelligence. They do not need to know everything. As long as they understand something better than others, they have an edge. The trouble with any kind of specialized knowledge is that one's area of expertise may not be especially interesting. But the theory of reflexivity serves to identify historically significant price movements, so it goes right to the heart of the matter. The rudimentary model I have outlined above has proved extremely rewarding in my career as an investor. That may seem surprising because the model is so simple and it fits a well-trodden stock market pattern so well that one would expect every investor to be familiar with it. Yet that is not the case. Why? Part of the answer must be that market participants have been misguided by a different theoretical construction, one derived from classical economics and, even more important, from the natural sciences. The ingrained attitude is that stock prices are the passive reflection of some underlying reality and not an active ingredient in the historical process. This view is simply false. It is remarkable that the error has still not been fully recognized. Nevertheless, investors do recognize the sequence I have described and do respond to it, only they respond later than someone who is working with the appropriate model and is on the lookout for the crucial features that define the shape of the price curve. That is what has given me my edge. The first time I used the model systematically was in the conglomerate boom of the late 1960s. It enabled me to make money both on the way up and on the way down. The key to the conglomerate boom was a prevailing misconception among investors. Investors had come to value growth in per-share earnings and failed to discriminate about the way the earnings growth was accomplished. A few companies learned to produce earnings growth through acquisitions. Once the market started to reward them for their performance, their task became easier because they could offer their own highly priced stock in acquiring other companies. In theory, the process works as follows. Let us assume that all of the companies involved have the same intrinsic growth in earnings, but the stock of the acquiring company sells at twice the earnings multiple of the acquired ones. If the acquiring company manages to double its size, its earnings per share jump by 50%, and its growth rate increases accordingly. In practice, the early conglomerates started out with high intrinsic growth rates that were rewarded by high multiples. Several of the pathbreakers were high-technology companies with a strong defense component whose managements recognized that their historic growth rate could not be sustained indefinitely. Textron, Teledyne, Ling Temco Vought, later LTV, to mention a few. They started to acquire more mundane companies, but as their per-share earnings growth accelerated, the multiples expanded instead of contracting. Their success attracted imitators, and later on even the most humdrum companies could attain a high multiple by going on an acquisition spree. For instance, the bulk of Ogden's earnings was derived from trading scrap metal. Nevertheless, the stock sold at more than 20 times earnings at its peak. Eventually, a company could achieve a high multiple just by promising to put it to good use by making acquisitions. Managements developed special accounting techniques that enhanced the impact of acquisitions. They also introduced changes in the acquired companies, streamlining operations, disposing of assets, and generally focusing on the bottom line. But these changes were less significant than the impact on per-share earnings of the acquisitions themselves. Investors responded. At first, the record of each company was judged on its own merit, but gradually conglomerates became recognized as a group. A new breed of investors emerged, the so-called go-go fund managers or gunslingers who developed a special affinity with the managements of conglomerates. Direct lines of communication were opened between them, and conglomerates would place so-called letter stock directly with investors. Eventually, conglomerates learned to manage their stock prices as well as their earnings. Events followed the sequence described in my model. Multiples expanded, and eventually reality could not sustain expectations. More and more people realized the misconception on which the boom rested, even as they continued to play the game. Acquisitions had to get larger and larger in order to maintain the momentum, and in the end they ran into the limits of size. The climactic event was the attempt by Saul Steinberg to acquire Chemical Bank. It was fought and defeated by the establishment. When stock prices started to fall, the decline fed on itself. The favorable impact of acquisitions on per-share earnings diminished, and eventually it became impractical to make new acquisitions. The internal problems that had been swept under the carpet during the period of rapid external growth began to surface. Earnings reports revealed unpleasant surprises. Investors became disillusioned, and managements went through their own crises. After the heady days of success, few were willing to buckle down to the burdens of day-to-day management. The situation was aggravated by recession, and many of the high-flying conglomerates literally disintegrated. Investors were prepared to believe the worst, and in some cases the worst actually occurred. In others, reality turned out to be better than expectations, and eventually the situation stabilized, with the surviving companies, often under new management, slowly working themselves out from under the debris. My best documented encounter with a boom-bust sequence is that of real estate investment trusts. REITs, as they are called, are a special corporate form brought into existence by legislation. Their key feature is that they can distribute their income free of corporate taxation, provided they distribute all the income they receive. The opportunity created by this legislation remained largely unexploited until 1969, when a large number of REITs were founded. I was present at the creation and, fresh from my experience with conglomerates, recognized their boom-bust potential. I published a research report, The Case for Mortgage Trusts. My report had an interesting history. It came at a time when go-go fund managers had suffered severe losses in the collapse of the conglomerates. Since they were entitled to share in the profits but did not have to share in the losses of the funds they managed, they were inclined to grasp at anything that held out the prospect of a quick profit. They instinctively understood how a self-reinforcing process works, since they had just participated in one, and they were anxious to play. The report found a tremendous response, whose extent I realized only when I received a telephone call from a bank in Cleveland asking for a new copy because theirs had gone through so many Xerox incarnations that it was no longer legible. There were only a few mortgage trusts in existence at the time, but the shares were so eagerly sought after that they nearly doubled in price in the space of a month or so. Demand generated supply, and there was a flood of new issues coming to market. When it became clear that the stream of new mortgage trusts was inexhaustible, prices fell almost as rapidly as they had gone up. Obviously, the readers of the report failed to take into account the ease of entry, and their mistake was corrected in short order. Nevertheless, their enthusiastic reception helped to get the self-reinforcing process described in the report underway. Subsequent events took the course outlined in the report. Mortgage trust shares enjoyed a boom that was not as violent as the one that followed the publication of the report, but turned out to be more enduring. I had invested heavily in mortgage trusts and took some profits when the reception of my study exceeded my expectations. But I was sufficiently carried away by my own success to be caught in the downdraft with a significant inventory. I hung on and even increased my positions. I followed the industry closely for a year or so and sold my holdings with good profits. Then I lost touch with the group until a few years later when problems began to surface. I was tempted to establish a short position, but was handicapped in that I was no longer familiar with the terrain. Nevertheless, when I reread the report I had written several years earlier, I was persuaded by my own prediction. I decided to sell the group short more or less indiscriminately. Moreover, as the shares fell, I maintained the same level of exposure by selling additional shares short. My original prediction was fulfilled, and most REITs went broke. The result was that I reaped more than 100% profit on my short positions, a seeming impossibility since the maximum profit on the short position is 100%. The explanation is that I kept on selling additional shares. Self-reinforcing, self-defeating cycles like the conglomerate boom and the REITs do not occur every day. There are long fallow periods when the specialist in such cycles remains unemployed. He need not starve, however. The divergence between underlying trends and investor recognition persists at all times, and the astute investor can take advantage of it. New industries arise or old ones come back into favor. Typically, they are inadequately followed at first. For instance, when defense spending started to rise in the early 1970s after a long decline, there were only 2 or 3 analysts left who followed the industry, although it still represented a substantial portion of the economy. Those who were left were too demoralized to recognize the beginning of a major new trend. That was a wonderful time to invest in defense stocks. There were high-tech defense stocks that had never been visited by an analyst, like E-Systems, Inc., and well-established companies that had fallen on evil days trying to diversify out of defense, like Sanders Associates, or getting caught up in scandals trying to sell airplanes through bribery, like Northrop and Lockheed. In the case of defense stocks, there was no self-reinforcing process involved, but investor recognition certainly helped the price of the stocks. Actually, it is a rare case where the investor's bias leaves the fundamentals totally unaffected. Even with defense stocks, the prevailing bias played a role, but it was a negative one. Lockheed had to be bailed out by the government, and companies like Sanders Associates had to restructure their debt by offering convertible bonds at prices that turned out to be very low in retrospect. Only when the negative bias was corrected was there very little further feedback. Companies had little need for additional capital, and managements, having been burned once before, were leery of diversifying out of defense. There were exceptions, like United Aircraft, but investors' bias never turned positive enough to allow a self-reinforcing process to get underway. Many of United Aircraft's acquisitions were for cash, and those that involved stock did not enhance earnings significantly. The result was a larger, diversified company, but no boom and bust in the stock. Perhaps the most interesting case of negative bias occurred in technology stocks. After the stock market debacle of 1974, investors were leery of any company that needed to raise equity capital from outside sources. Distributed data processing was in the early stages of its development. New companies like DataPoint and Fourphase were in the vanguard, with IBM lagging badly. The market was practically exploding, but these little companies were hamstrung by their inability to raise capital. The stocks were selling at very low multiples of anticipated earnings, and the main argument against them was that they would not be able to grow fast enough to meet the demand, and eventually IBM would move into the market. The argument turned out to be valid, but not before these companies became large and prosperous, and investors became eager to throw money at them at high multiples. Those who had been willing to fight the negative bias were amply rewarded. As the various niches occupied by these small companies converged to form a large market, Most of them were absorbed by larger companies, and those that stayed independent fell on evil days. Data Point is currently looking for a home at a much reduced multiple. Four-Phase was recently acquired by Motorola, which proceeded to lose its shirt on it. If the initial market reaction to distributed data processing companies had been more positive, it is possible that some of the early starters might have grown fast enough to survive, just as the earlier wave of microcomputer manufacturers did spawn a few enduring companies like Digital Equipment and Data General. The negative bias of the 1975 to 1976 period gave way to the opposite extreme. It found expression in a venture capital boom that culminated in the second quarter of 1983. The sequence of events is not as clear-cut as in the case of REITs, but that is only because high technology is not as homogeneous an industry. The same reflexive interaction between stock prices, prevailing bias, and fundamentals can be observed, but much more specific knowledge is required to trace the course of events. The availability of venture capital on attractive terms led to a proliferation of new ventures. Every new company needed equipment as well as inventory, so that electronic equipment manufacturers enjoyed a boom, and so did the manufacturers of products and components. The electronics industry is a large customer of its own products, so that the boom was self-reinforcing. But the proliferation of companies intensified competition. Industry leaders lost their market position as a new generation of products was introduced because the individuals who were responsible for developing them left their companies and set up new ones. Instead of companies growing in step with their industry, the industry grew by the multiplication of companies. Investors failed to recognize this trend. As a result, technology stocks in general and new issues in particular became substantially overvalued. The new issue boom culminated in the second quarter of 1983. When prices started to decline, fewer issues could be sold, and eventually venture capitalists became less venturesome. As fewer companies were formed and the existing ones depleted their cash, the market for technology products softened. Competition intensified and profit margins deteriorated. The process started to feed on itself, and the low point has probably still not been reached. The venture capital boom was not the only cause of the subsequent shakeout. The strong dollar and the rise of Japanese competition were at least as important. But it is clear that stock prices had an impact on the fundamentals in both directions. What distinguishes the conglomerate and REIT sequences from the venture capital boom is that in the first two cases the underlying trend itself was based on the exploitation of the investor's bias, while in the third it was not. In the case of conglomerates, the idea was to acquire other companies with inflated paper. In the case of REITs, the idea was equity leveraging. The idea behind the latest generation of technology products had nothing to do with the stock market. To understand the ups and downs of technology stocks, we must know something about the underlying trends in technology. In the case of conglomerates and REITs, we need to know little else than the theory of reflexivity. It is important to realize, however, that knowing everything about underlying trends in technology is not sufficient to explain the ups and downs of technology stocks. The reflexive interaction between underlying trends, prevailing biases, and stock prices also needs to be understood. Combining the two kinds of understanding is extremely difficult. Those who want to be familiar with technology must follow the industry closely and continuously. Those who want to exploit the divergence between perception and reality must move from group to group. Most technology experts are ignorant of reflexivity and tend to remain fully invested at all times. Their popularity and influence wax and wane in a reflexive fashion. After the recent decline in technology stocks, a new breed of analysts seems to be emerging who are overly sensitive to the importance of investors' perceptions. After a decent interval, it may be once again profitable to go against the prevailing bias and invest in technology stocks on the basis of fundamental trends. I have always had a lot of difficulty investing in technology stocks because of the specialized knowledge required. Finally, I managed to gain a good insight into the computer industry during the 1975 to 1976 period and profited from the prevailing negative bias. I held on to my positions for a few years, but then I sold them and lost my grip on the industry. In 1981, I made the mistake of not participating in a venture capital fund operated by one of the most successful venture capitalists of the period, in the belief that the boom could not last long enough to allow investors to exit in time. In this, I was undoubtedly influenced by misgivings about the larger picture. In any event, his investors realized a good profit in 1983. By that time, I was totally out of touch with technology stocks, and the boom passed me by. Even the conglomerate and REIT sequences were not totally self-contained. Extraneous developments, such as the level of economic activity, regulation, or specific events, e.g. the attempted takeover of Chemical Bank, played a crucial role in the conglomerate boom. In less pure sequences, the importance of outside influences is even greater. We are currently in the midst of another self-reinforcing, self-defeating cycle that will go down in history as the merger mania of the 1980s. Instead of inflated paper, it is cash that serves as the currency. The scale of transactions already dwarfs the conglomerate boom. Merger mania is but an element of a much larger ongoing historical drama whose ramifications reach far beyond the stock market and involve politics, exchange rates, monetary and fiscal policies, quirks of taxation, international capital movements, and many other developments. I shall make an attempt at unraveling the ongoing historical drama, but that is not as simple as analyzing a more or less self-contained boom-bust sequence. The larger picture is full of reflexive interactions as well as non-reflexive fundamental trends. We need a more complex model that allows for the transition from one boom-bust sequence to another and for the coexistence of several reflexive processes at the same time. Before I embark on such an ambitious project, I want to examine another market that is characterized by vicious and benign circles: the currency market. Reflexivity in the currency market. While reflexive interactions are intermittent in the stock market, they are continuous in the market for currencies. I shall try to show that freely floating exchange rates are inherently unstable. Moreover, the instability is cumulative, so that the eventual breakdown of a freely floating exchange rate system is virtually assured. The traditional view of the currency market is that it tends toward equilibrium. An overvalued exchange rate encourages imports and discourages exports until equilibrium is re-established. Similarly, an improvement in competitive position is reflected in an appreciating exchange rate that reduces the trade surplus so that equilibrium is again re-established. Speculation cannot disrupt the trend toward equilibrium. If speculators anticipate the future correctly, they accelerate the trend. If they misjudge it, they will be penalized by the underlying trend that may be delayed but will inexorably assert itself. Experience since floating exchange rates were introduced in 1973 has disproved this view. Instead of fundamentals determining exchange rates have found a way of influencing the fundamentals. For instance, a strong exchange rate discourages inflation. Wages remain stable and the price of imports falls. When exports have a large import component, a country can remain competitive almost indefinitely in spite of a steady appreciation of its currency, as Germany demonstrated in the 1970s. The fact is that the relationship between the domestic inflation rate and the international exchange rate is not unidirectional, but circular. Changes in one may precede changes in the other, but it does not make sense to describe one as the cause and the other as the effect, because they mutually reinforce each other. It is more appropriate to speak of a vicious circle in which the currency depreciates and inflation accelerates, or of a benign circle where the opposite happens. Vicious and benign circles are a far cry from equilibrium. Nevertheless, they could produce a state of affairs akin to equilibrium if the reflexive, mutually self-reinforcing relationship could be sustained indefinitely. But that is not the case. The self-reinforcing process tends to become more vulnerable the longer it lasts, and eventually it is bound to reverse itself, setting in motion a self-reinforcing process in the opposite direction. A complete cycle is characterized by wide fluctuations, not only in the exchange rate, but also in interest rates, inflation, and/or the level of economic activity. The participant's bias introduces an element of instability into the system. If the system had an innate tendency toward equilibrium, the participant's bias could not disrupt it. At worst, it could introduce some random, short-term fluctuations. But when the causal connections are reflexive, the participant's bias may engender, sustain, or destroy a vicious or benign circle. Moreover, the prevailing bias takes on a life of its own as one of the constituent parts in a circular relationship. It finds expression in speculative capital movements that may serve as a counterweight to an imbalance in trade, allowing a trade surplus or deficit to exceed, both in size and in duration, the level that could have been sustained in its absence. When that happens, speculation becomes a destabilizing influence. International capital movements tend to follow a self-reinforcing, self-defeating pattern similar to the one we identified in the stock market. But the model we used for stock price movements cannot be applied to currency markets without substantial modifications. In the stock market, we focused on the reflexive relationship between two variables, stock prices and a single underlying trend. We were trying to build the simplest possible model, and we were willing to simplify a much more complex reality to serve our purpose. In the currency market, we cannot get by with two variables. Even the simplest model will need 7 or 8. Expectations about exchange rates play the same role in currency markets as expectations about stock prices do in the stock market. They constitute the paramount consideration for those who are motivated by the total rate of return. In the stock market, that covers practically all investors. In currency markets, all speculative transactions. In the stock market, we used a model that focused on stock prices and disregarded dividend income. No great distortion was involved, because in the kind of boom-bust sequences we were considering, stock price movements far outweigh dividend income. Similar conditions prevail in currency markets. Expectations about future exchange rates constitute the main motivation in speculative capital transactions. The major difference between the stock market and the currency market seems to be the role played by the fundamentals. We have seen that the fundamentals were rather nebulous even in the case of stocks, but at least we had no reason to doubt that stock prices were somehow connected to the fundamentals. In the case of currencies, the trade balance is clearly the most important fundamental factor. Yet the dollar strengthened between 1982 and 1985, while the trade balance of the United States was deteriorating. It would seem that the fundamentals are even less relevant in determining price trends than in the stock market. We do not need to look far afield for an explanation. It is to be found in the relative importance of speculative capital movements. As we have seen, speculative capital is motivated primarily by expectations about future exchange rates. To the extent that exchange rates are dominated by speculative capital transfers, they are purely reflexive. Expectations relate to expectations, and the prevailing bias can validate itself almost indefinitely. The situation is highly unstable. If the opposite bias prevailed, it could also validate itself. The greater the relative importance of speculation, the more unstable the system becomes. The total rate of return can flip-flop with every change in the prevailing bias. In our discussion of the stock market, we identified certain sequences, such as the conglomerate boom, where the prevailing bias formed an important part of the underlying trend. But we concluded that such pure examples of reflexivity are exceptional. By contrast, in a system of freely fluctuating exchange rates, reflexivity constitutes the rule. Of course, there is no such thing as a purely reflexive situation. Speculation is only one of the factors that determine exchange rates, and the other factors must also be taken into account in formulating one's expectations. Thus, expectations cannot be totally capricious. They must be rooted in something other than themselves. How a prevailing bias becomes established, and, even more important, how it is reversed, are the most important questions confronting us. There are no universally valid answers. Reflexive processes tend to follow a certain pattern. In the early stages, the trend has to be self-reinforcing, otherwise the process aborts. As the trend extends, it becomes increasingly vulnerable because the fundamentals, such as trade and interest payments, move against the trend in accordance with the precepts of classical analysis, and the trend becomes increasingly dependent on the prevailing bias. Eventually, a turning point is reached, and, in a full-fledged sequence, a self-reinforcing process starts operating in the opposite direction. Within this general pattern, each sequence is unique. It is the characteristic feature of a reflexive process that neither the participants' perceptions nor the situation to which they relate remain unaffected by it. It follows that no sequence can repeat itself. Not even the variables that interact in a circular fashion need be the same. Certainly they will not carry the same weight on different occasions. Although each self-reinforcing circle is unique, we can make some universally valid generalizations about freely fluctuating exchange rates. First, the relative importance of speculative transactions tends to increase during the lifetime of a self-reinforcing trend. Second, the prevailing bias is a trend-following one, and the longer the trend persists, the stronger the bias becomes. The third is simply that once a trend is established, it tends to persist and to run its full course. When the turn finally comes, it tends to set into motion a self-reinforcing process in the opposite direction. In other words, currencies tend to move in large waves, with each move lasting several years. These three tendencies are mutually self-validating. It is the growth in speculative capital flows moving in a trend-following fashion that makes the trend so persistent. It is the persistence of the trend that makes a trend-following bias so rewarding, and it is the rewards reaped by speculation that attract increasing amounts of capital. The longer a benign circle lasts, the more attractive it is to hold financial assets in the appreciating currency, and the more important the exchange rate becomes in calculating total return. Those who are inclined to fight the trend are progressively eliminated, and in the end only trend followers survive as active participants. As speculation gains in importance, other factors lose their influence. There is nothing to guide speculators but the market itself, and the market is dominated by trend followers. These considerations explain how the dollar could continue to appreciate in the face of an ever-rising trade deficit. Eventually, a crossover point would have been reached, even without the intervention of the authorities, when the inflow of speculative funds could not keep pace with the trade deficit and with rising interest obligations, and the trend would have been reversed. Since the predominating bias is trend-following, speculative capital would then have started moving in the opposite direction. If and when that happened, the reversal could easily have accelerated into a free fall. For one thing, speculation and fundamental flows would then have worked in the same direction. Even more important, when a change in trend is recognized, the volume of speculative transactions is likely to undergo a dramatic, not to say catastrophic, increase. While a trend persists, speculative flows are incremental. But reversal involves not only the current flow, but also the accumulated stock of speculative capital. The longer the trend has persisted, the larger the accumulation. There are, of course, mitigating circumstances. One is that market participants are likely to recognize a change in trend only gradually. The other is that the authorities are bound to be aware of the danger and do something to prevent a crash. How the drama actually unfolded will be the subject of a later chapter. Here we are trying to establish a general proposition. Taking the three generalizations together, it can be asserted that speculation is progressively destabilizing. The destabilizing effect arises not because the speculative capital flows must be eventually reversed, but exactly because they need not be reversed until much later. If they had to be reversed in short order, capital transactions would provide a welcome cushion for making the adjustment process less painful. If they need not be reversed, the participants get to depend on them so that eventually when the turn comes, the adjustment becomes that much more painful. It is quite likely that the generalization about the progressive accumulation of hot money holds true not only within a cycle, but also from one cycle to another. although the history of fluctuating exchange rates is too short to provide reliable evidence. It has certainly been true so far. The size of speculative capital movements was far greater in Reagan's benign circle than it was during Carter's vicious circle. Empirical studies of the 1930s also showed a cumulative growth in hot money movements, although circumstances were somewhat different because currencies were not freely floating. We can see why hot money should continue to accumulate as long as real interest rates are high and the return on physical investments low. Keeping capital in liquid form in an appreciating currency is more rewarding than investing it in physical assets. What is needed to give the generalization universal validity is an argument that would show that fluctuating exchange rates are associated with high returns on financial assets and low returns on physical investments. Let me try. We have seen that hot money can earn exceptional returns if it gets the trend right. Since it sets the trend, that is likely to be the case. Physical assets represent the opposite side of the coin. They cannot move to take advantage of the trend. The tradable goods sector is bound to suffer when a currency appreciates. Of course, a depreciating currency brings windfall profits to exporters, but having been hurt before, exporters are loath to invest in the basis of a temporary advantage. They prefer to hold their profits in financial assets, contributing to the growth of hot money. The process can be most clearly observed in the United Kingdom, where exporters refused to expand when sterling fell below $1.10 in 1985, despite record profits. How right they were! Sterling rose above $1.50 by April 1986. Thus, both an appreciating currency and a depreciating currency discourage physical investment and foster the accumulation of hot money. We can attempt yet another tentative generalization. When a long-term trend loses its momentum, short-term volatility tends to rise. It is easy to see why that should be so. The trend-following crowd is disoriented. The generalization is tentative because it is based on inadequate evidence. It certainly was true when the dollar reversed its trend in 1985. If these generalizations are indeed valid, the eventual demise of a system of freely fluctuating exchange rates is inevitable. Fluctuations become so wild that either the system has to be modified by some kind of government intervention, or it is bound to break down. Currency markets thus provide the best support for my contention that financial markets are inherently unstable. There is no built-in tendency toward equilibrium. To the extent that we need stability, we must introduce it by deliberate policy measures. These conclusions may not strike the reader as particularly revolutionary at the present time, but they certainly contradicted the prevailing wisdom at the time they were written in April to May 1985. There was widespread malaise about the instability of exchange rates, but belief in the magic of the market was still running strong. And the famous Plaza Agreement in September 1985 came as something of a shock to market participants. Even today, there is no theoretical underpinning for the contention that a freely floating exchange rate system is cumulatively destabilizing. That is what I hope to have provided here. I have been speculating in currencies ever since they started floating, but I have failed to make money on a consistent basis. On balance, I traded profitably through 1980, then chalked up losses between 1981 and 1985. My approach has been tentative, based more on intuition than on conviction. By temperament, I have always been more interested in picking the turning point than in following a trend. I managed to catch both the rise and fall of European currencies against the dollar until 1981, but I traded myself out of my positions too soon. Having lost the trend, I found it too demeaning to start following the trend followers. I tried to pick the reversal point instead, needless to say, without success. I had some temporary profits in the early part of 1984, but I gave them all back. I was again engaged in a speculation against the dollar at the time I wrote this chapter. Writing it has undoubtedly helped to clarify my thoughts. Admittedly, the theory is far too abstract to be of much use in making concrete predictions. Specifically, the turning point cannot be determined until it has actually occurred. But as we shall see, the theory can be very useful in interpreting events as they unfold. The credit and regulatory cycle. There seems to be a special affinity between reflexivity and credit. That is hardly surprising. Credit depends on expectations. Expectations involve bias. Hence, credit is one of the main avenues that permit bias to play a causal role in the course of events. But there is more to it. Credit seems to be associated with a particular kind of reflexive pattern that is known as boom and bust. The pattern is asymmetrical. The boom is drawn out and accelerates gradually. The bust is sudden and often catastrophic. By contrast, when credit is not an essential ingredient in a reflexive process, the pattern tends to be more symmetrical. For instance, in the currency market, it does not seem to make much difference whether the dollar is rising or falling. The exchange rate seems to follow a wave-like pattern. I believe the asymmetry rises out of a reflexive connection between loan and collateral. In this context, I give collateral a very broad definition. It will denote whatever determines the creditworthiness of a debtor, whether it is actually pledged or not. It may mean a piece of property or an expected future stream of income. In either case, it is something on which the lender is willing to place a value. Valuation is supposed to be a passive relationship in which the value reflects the underlying asset, but in this case, it involves a positive act. A loan is made. The act of lending may affect the collateral value. That is the connection that gives rise to a reflexive process. It will be recalled that we have analyzed reflexivity as two connections working in opposite directions. The normal connection, where a value is placed on future events, as in the stock market or banking. We have called it the cognitive function, and a perverse connection in which expectations affect that which is expected. We have called it the participating function. The participating function is perverse because its effect is not always felt, and when it does operate, its influence is so difficult to disentangle that it tends to go unrecognized. The prevailing view of how financial markets operate tends to leave the participating function out of account. For instance, in the international lending boom, bankers did not recognize that the debt ratios of borrowing countries were favorably influenced by their own lending activity. In the conglomerate boom, investors did not realize that per-share earnings growth can be affected by the valuation they place on it. At present, Most people do not realize that the erosion of collateral values can depress the economy. The act of lending usually stimulates economic activity. It enables the borrower to consume more than he would otherwise, or invest in productive assets. There are exceptions, to be sure. If the assets in question are not physical but financial ones, the effect is not necessarily stimulative. By the same token, debt service has a depressing impact. Resources that would otherwise be devoted to consumption or the creation of a future stream of income are withdrawn. As the total amount of debt outstanding accumulates, the portion that has to be utilized for debt service increases. It is only net new lending that stimulates, and total new lending has to keep rising in order to keep net new lending stable. The connection between lending and economic activity is far from straightforward. That is, in fact, the best justification for the monetarist's preoccupation with money supply to the neglect of credit. The major difficulty is that credit need not be involved in the physical production